Welcome to today's event where we have the pleasure to present MPC Energy Solutions. To help us through, we are joined by CFO and interim CEO Stefan Meisner. Today's event, we will cover the 23 results, we will cover the outlook you gave here and a strategy update and a follow-up on what you already announced earlier this February. You are encouraged to ask questions during the presentation as a viewer. Do it in the box down below. We will take most of the questions in the end of the event. But I think for now, Stefan, I will hand the call over to you.
Thank you so much, Michael. And a warm welcome to everyone. Thanks again to the team of HCA to host us today. Like we did before, it's always a pleasure to present a brief update on what we've been up to. To get us started, for those of you joining for the first time, I'd like to give a very, very brief intro into the business that our company has and what we're doing. So MPC Energy Solutions was founded around 3 years ago, and we are what we call in the industry an independent power producer that covers the entire value chain of renewable energy projects. That means we develop projects from scratch, greenfield, as we say. We take them through development and construction all the way to operation. And then most commonly, we stay invested as an owner and operator of these plants for the long time. And lifetimes of our projects range from 30 years to 40 years or even more. Since we've been established, we focus exclusively on the region Central America and the Caribbean, meaning from Mexico all the way down to Colombia and then the way into the Eastern Caribbean islands like Puerto Rico, for example. And while our business is what we call technology agnostic, meaning we don't care whether it's solar or wind or a hybrid solution, including storage, which we believe will drive growth for the foreseeable decades, it's important that it's a renewable energy source. And as you can imagine, in that part of the world, solar photovoltaics is a very, very predominant technology. And almost our entire portfolio and our entire development pipeline consists of projects from solar photovoltaics. I just heard that my camera might not be working, so let me give it a quick check. It should be okay. Not exactly sure. All right. Well, my camera is on.
I think we will just run it without cameras this time.
Fair enough. Fair enough. Okay. Well, as long as you can hear me, that's all well.
Yeah, we can hear you perfectly.
All right, terrific. So this is what we do. We cover the entire life cycle of renewable energy projects in Central America and the Caribbean, and our primary focus is solar. And we believe that especially storage technologies will play a very, very important role whenever deploying renewable energy in the future. Our current portfolio, since we started building this company 3 years ago, we put 5 projects in operation. 4 of them solar PV plants in Mexico, in Colombia, and in El Salvador, and 1 of them a combined heat and power plant in Puerto Rico. So in total, we today own and operate 80 megawatts. And in March, early March of this year, we just started construction of our biggest project yet, 65 megawatt solar PV plant in Guatemala that will sell electricity under a 16-year power purchase agreement to a very, very well-known local off-taker. More on that project a little bit later. Before I go into what we were up to in 2023 and give an outlook to 2024, let me briefly explain why we are exclusively engaged in Central America and the Caribbean. There are a couple of reasons. Reason number 1 is, of course, we do have a lot of renewable energy sources like solar and wind along the coastlines. So overall, this is a region that has a lot of potential for renewable energy sources to be used. Secondly, all the governments in the region exclusively have set very ambitious goals to turn the current energy mix into 100% renewables over the next 10, 20, 30 years, depending on which country you look at. Renewable energy today is either underrepresented in the energy mix. If you look at some Caribbean islands, you will see that they depend to 90-95% on, for example, diesel generators that they use, which is not only very expensive, it's also extremely fossil-based and therefore heavy on emissions. So we see undiversified energy mixes or an underrepresentation of renewables in the field, and consequently, energy prices in the region are among the highest that end users pay globally. So for a power plant operator like ourselves, whenever we can sell electricity at relatively higher prices, still below what people pay today, but higher than what we may be used to in Europe or other Western industrialized nations, it compensates us for the additional perceived risk that we're taking for investing into renewable energy projects in developing and emerging markets. 2023 for us was very much a transitional year. We're still a small company. We're still getting our bearings, and 2023 highlighted this. We were able to commission 4 new projects. So the total of 5 projects that we currently have in operations, 4 of them were actually connected to the grid throughout 2023, which also means that we've never seen a full year output from our entire portfolio. 2024 will be the first time that happens. In Guatemala, we signed a long-term power purchase agreement with the IMSA Group, which is the region's largest processor of sugarcane and refiner of sugar. Very, very well-established company that is predominantly operating in Central America, but also exporting quite a lot of their product. And they are also responsible for producing around 8% of Guatemala's energy output. So the IMSA Group is really a big deal down there, and we are very happy that we were able to sign them on as our client. And once the new project is built, and will be commissioned by middle of 2025, we will see that this not only has a big impact for Guatemala and the IMSA Group, but also for us as a company. To solidify our future growth, we need new projects to develop, and we started new developments in Guatemala, in El Salvador, and in Panama late last year. We assigned a significant amount of our capital to developing these projects to ready to build over the coming 12 to 24 months, because only when we develop projects greenfield and we get them to the ready to build stage is where our business model truly works. More on that a little bit later. Of course, with so many new projects coming online, even throughout the year, we saw a significant increase in revenues and cash flows. I will share the numbers on the next slide. And also very important, especially to those of us who are very much, or to those shareholders and interested investors that are very much focused on us realizing proper project returns, we constantly monitor our backlog and our project pipeline, and we very clearly eliminate those and stop those that we believe do not add any significant strategic value, and they no longer meet our return requirements. And several projects with rising interest rates have no longer been able to meet the benchmarks that we set internally. So we successfully divested 2 projects in St. Kitts and 1 in Puerto Rico, which means we repatriated most of the money that we invested to make sure that we solidify our own cash position, which allows us to be flexible when new projects come along. If we look at the financial output for 2023, the energy output is up, project revenues are up, surpassing 9 million last year. Our project EBITDA, margin-wise, not where we wanted to be. We had some one-off effects like trading losses in Colombia, which are now contained. We also had a restructuring ongoing for a project we acquired in Mexico. So there are a couple of reasons why project EBITDA is not where it should be, or it wasn't where it should be. It will be in 2024. But we still more than doubled our operating profit in 2023 as more projects came online, and we were able to commission more projects and expand our portfolio. So looking at this, a transitional year still allowed us to increase our key metrics across all fronts. And especially, we were able to address issues that we had, for example, with construction delays in Colombia. Now that the projects are online, we no longer need to cover the delivery of energy through the spot market, which hurt us greatly in the last 1.5 years. This is now contained. And as I mentioned, the project that we acquired in Mexico in 2022, we just completed restructuring the cost base so that the project can finally deliver margins that we believe are required for renewable energy projects. And just to give you an idea, project EBITDA margins for solar PV plants in the region, in our view, should deliver EBITDA margins of around 80%, in some cases 75%, in some cases a little bit more than 80%, but 80% is what we target across our entire portfolio. And as you can see in 2023, we were definitely not there yet, but we will be in 2024. Looking at our audited results, just to give you an idea about the size of our balance sheet. So we closed the year with 123 million in total assets. Most of that is, of course, fixed assets, our investment in renewable energy projects, our investments into the fixed assets that power plants require, like solar modules, like tracking systems, like substructures, inverters, cabling, you name it. We are still significantly low leverage. We have project finance loans, non-recourse, which is quite common for renewable energy projects, but we don't have them for all of our projects. Some of them are still entirely equity financed because the construction and the start of operation coincided with interest rates going up, and we did not just borrow money at any rate. We want to make sure that it's a competitive rate that helps us actually improve the returns of our projects. And where that wasn't possible, we simply decided to not wait for interest rates to come down to start construction and to start operating these assets. We simply paid for them with our own money entirely. And of course, as interest rates are expected to come down in the future, we will try to put more leverage on these projects as well, so that the equity ratio in our capitalization is still very strong. But it's certainly not within industry benchmarks, where it's more common to have, let's say, 20 to 30% equity ratio compared to our 56%. Out of the 87 million in cash that we raised 3 years ago when we went public, we have around $15 million in free cash, or we had at the end of 2023. This gives us a lot of flexibility to simply deploy capital into new developments, also to fund construction in Guatemala, to pay for our overhead and everything, not only for 2024, but also for 2025 and potentially beyond, meaning that at the moment we have sufficient reserves to do what we want to do in the next 2 years or more without requiring to go out and raise additional debt and capital in a market environment that we still find not ideal for these kind of measures, with interest rates remaining high, with our stock remaining or trading below what we believe is its intrinsic value, and therefore issuing capital at such low prices is simply nothing that we want to do. And then I think also a very relevant factor, even though our group EBITDA, meaning our project profits minus our overhead, was still negative in 2023, it was a significant increase compared to 2022. And this year, 2024, we will definitely see a substantial positive EBITDA and EBIT, so operating profit in total, also on group level. Final remark on the results of 2023, just to give listeners an idea about the seasonality of our business. As I said before, the technology that we operate is predominantly solar photovoltaics, meaning that the output and consequently the revenue and the profit have a certain seasonal pattern, where Q3 and Q4 are the strongest quarters that we have, and the winter months at the end of Q4 and early Q1 are usually those months where we see lower outputs and consequently also lower revenues. But overall, this is a pattern that as long as solar PV will be the predominant technology that we deploy, it will also be the seasonal pattern that our business is driven by. Which concludes my review of 2023, and I'd like to look ahead a little bit and give listeners the idea what we're looking for in projects as a full cycle IPP. I mentioned before that for me especially, meeting the equity return requirements that we know our shareholders have, and by extent we have, is absolutely key. We cannot invest in projects that do not meet our hurdle rates when we look for investments. Yes, sometimes you might see a project that has a superb strategic value. It helps you scale. It helps you cover your overhead and your development expenses, and maybe it is a lighthouse project like deploying a hybrid solution with storage on a Caribbean island that will lead to additional projects in the future. In these cases, we may take a look and say, okay, we maybe don't have to earn 15% return on equity here. Maybe 13 is fine as long as we see a strategic value. But ultimately, we will be driven by the equity return requirements that our shareholders expect us to meet. Greenfield is very much what we're looking for in new projects, and we want to do it utility scale. Ideally, at the higher end of our range, the Guatemala project, we just started construction on a 65 megawatt peak. That's a very nice size. It's of course not cheap to build. It requires a lot of capital, but with the right reserves that we have, this can be managed. And the work to, let's say, develop and build a 25 megawatt project is fairly similar to when you do it for a 75 megawatt project. So clearly, the higher range of utility scale sizes is what we're looking at. A very important factor in our business model is that we no longer focus on owning everything 100% through operation. We've done so in the past, but when I took over in the middle of last year, I shifted focus to finding co-investors at the ready-to-build stage. And I will get to that in a minute, but it actually means that we develop the projects ourselves. But the moment they approach the ready-to-build status, we need to make a conscious decision. Do we want to sell the project entirely? Or do we want to build the project together with a co-investor, still retaining the majority, but not being exposed 100%, which has a very great benefit that I will demonstrate on the next slide. And of course, bankability of off-takers, especially in a region that a lot of people find adds additional risk. These are countries that are not the most solvent. We look for off-takers that detach us from the risk that some people believe the investments in the country themselves pose. We work with very, very bankable and credit-worthy off-takers, AAA rated companies locally, whether it's large utilities or large industrial clients. So selecting the right clients for the power that we produce, we actually spend a lot of time on that. And this is something that we need to see in a project to move forward with it. I mentioned that we want to bring in co-investors or sell projects entirely once the development phase is over. Why do we do this? It is, for us, developing projects theoretically has a lot of risks, because this is the phase where most of the projects you start don't make it through. Some developers manage to get 1 out of 10 projects to ready to build. Others say maybe it's 20%. Our hit rate has been a little bit higher in the past, and we want to keep it that way by very, very carefully selecting the right projects. And when we get to the ready-to-build stage and construction is about to start, this is when most of the capital is required, of course. And when we sell part of the project, we are able to collect a development fee as a compensation for the development risks that we took and for the work that we have done from a potential co-investor. The money that we're getting as a development fee, we can basically invest in the construction, and thereby we lower the construction equity that we need to build a project substantially. Let me give you an example. Let's say that the equity requirement to build a plant is $10 million, and we want to sell 50% of that, then our normal equity requirement would be around $5 million. But if the co-investor is willing to pay us, let's say 3 or 4 million in development fee, depending on the size of the project, the technology, and the country, we can lower our equity contribution by considering the development fee to around 1 million or 2 million. So we retain 50% of all future cash flows and the benefits that come with it, but we only need to put in 10 or 20% of the total equity required because we netted with the development fee. And this is the business that we're in, and this is the business that we want to focus on a little bit more. Securing these greenfield returns is really a core component of our strategy going forward.
Stefan, when a project is finished, then you talked about it's the bankability of your PPAs. But when you go to a construction phase, you also have risk of the construction phase. Which are you partnering up with? How can you convince investors that you have the right construction partners, that you will not have delays? I guess it adds another part where you need to kind of convince investors that this is a good project, if you understand what I mean. And it's not something we have seen very often in your business. So how are you actually doing that?
Well, this is an excellent question. So we sign turnkey contracts with the large construction companies to really build the projects for us. until they're ready to operate. Does this eliminate all the risk? No, it doesn't. You still need the right partner that can also withstand delays and has substantial resources to cover any cost overruns that specific contractor costs. We are mostly working with, let's say, internationally known contractors. For example, our power plant in El Salvador was built by the Indholdet group, a European EPC contractor that was able to build the project in time and budget. And this is also the company that we now engage to build the 65 megawatt project in Guatemala. And we see that a lot of internationally known contractors are active in the region, not only the big countries like Colombia and Mexico, but also in between and in the Caribbean. So let's say selecting the right contractor is absolute key. Does this eliminate the construction risk overall? No, it doesn't. We still need to very actively manage and oversee construction, which is why we have our own construction team in the region that closely manages and monitors everything that's going on. So with the turnkey contracts, with well-known contractors supervised by our own team, this is really how we're trying to minimize construction risk. We can never fully eliminate it, but the track record shows that whenever we have this constellation and we work with the right companies, the construction risk is not such a big deal. It's also
so the bankability is on your partners you choose for the project. That's the case here. I guess, like the bankability of the PPA off-taker.
Absolutely, and so this is exactly the point. You need a bankable, a credit-worthy EPC contractor, and of course, whenever we get non-recourse financing, this is one of the main questions that the bank asks. The second question is, who are you selling the electricity to, and can that company pay its bills for the foreseeable future, like 15 or 20 years? And these are the questions we need to answer, not just for ourselves, but also to the banks that we engage. So a lot of time and due diligence is spent on minimizing the risk. Even though looking into the future for 20 years is difficult, we of course want to have a high level of certainty that we are selecting the right partners.
Perfect.
Right.
But that explains it, because you're moving some risk to an investor, and of course also some of the returns, but you get a much lower equity rate today. If I can, you also get the fees for development, right? So
Right. It
was just to get an understanding on how you work with that side, and convincing investors to go in at that early stage.
No, absolutely. And I think what our co-investors, or the co-investors that we will be looking for our projects in Guatemala, is the one where we want to demonstrate that this actually works for the first time, is that we have the expertise in the field. A lot of the co-investors don't, but they have the capital that needs to be deployed, and they, ultimately the risk is, I think, shared appropriately. And if it wouldn't work, then ultimately no one would co-invest, and then no one would start even developing these projects. And our track record, I think, enables us to continue what we've been doing for the past years. And now the big changes here that we want to take money off the table and reduce our own exposure early on, and not finance 100% of the construction ourselves, because it's simply not necessary. And I think we also don't see the upside that development, successful development brings. You don't see that later in the project for whatever reason. You really need cash in when the project is ready to build.
Perfect, thanks.
All right. So when we last presented here, and also to the investment community at large, we defined certain pillars of, let's say, our revised focus that we had as a company, and now that we're entering a more stable phase. We were able to already shore up our cash reserves. We have nearly 15 million in the bank and can very flexibly react to any opportunities that might come along. We also shifted the focus to greenfield development much more quickly. And we're still actively working on optimizing our existing portfolio. There's always stuff you can do to improve the margins, to improve the free cash flows, to make sure that the technical performance is solid or improved. So overall, we are making very good progress also on reducing our overhead to match the size of our company. So overall, the changes that we implemented late last year, after we had the change in leadership and refocused the company, is very well underway. Which brings me to what's coming next. And what's coming next for us is, as I mentioned, that we have the clear focus on the greenfield returns, and we need to demonstrate that it works. We always need to keep an eye on how quickly do we scale the business and how much do we simply sell projects at ready to build to make sure that we collect development fees and can redeploy capital and other growth opportunities. And I think something that maybe was overdone in the past, the organization was built in a way that we would scale up very, very quickly. But of course, scaling up in our kind of business requires access to a lot of capital. And in times where interest rates are high and return pressure comes our way, we need to be smart about this. And that also means that we need to keep an eye on the flexibility of our organizational structure and the size of our organizational structure. Because at the end of the day, we want to build a profitable and self-sustainable company that is dominating in the markets that it operates in without, risking us not meeting the return expectations that we have. And whether these return expectations go up or down, we need to be able to react to it. 2024 will already demonstrate how this works. It is the very first time that our entire portfolio will see a full year contribution. So for the very first time, all 5 projects in our portfolio will contribute to our output revenue and profits from January to December. On top of that, now that the Colombian projects are up and running, we're in normal operating modes. We no longer need to heavily trade energy in the market, which means that the trading losses we incurred in the past and which were reflected in our 2023 results are now contained. And as I mentioned before, the Mexican project, which was undergoing some restructuring ever since we acquired it in 2022, is now also where we want it to be. So we will see proper margin contributions from that project as well. Our overhead cost cutting measures already demonstrate results, which we will also show in the Q1 reporting, which we will do at the end of this month. And of course, a lot of focus will be on building the largest power plant in our portfolio to date, the San Patricio project in Guatemala. And if we manage all of this well, what we will see is that our energy output will go up significantly. Project revenues will go up by 1/3 to $12 million this year, and project EBITDA will almost double to 8.5 million. In addition, the average price per megawatt hour will also see a slight increase again. So overall, everything that we've done to date, transitioning from 1 operating asset to 5 in 2023, to making certain divestments, to changing the strategy, to really refocusing the company, we will see these results bear fruit, these measures bear fruit in the results that we expect for 2024. And given that we are operating in a very, very stable business with highly predictable cash flows, I am extremely confident that we can deliver on the numbers that we've shared here with the market. And then beyond that, it's the 65 megawatt project in Guatemala, San Patricio Renovables. We expect it to start operations in the middle of 2025. And once it's fully operational, it will almost double our capacity and output. It will, on its own, contribute 8 million in annual revenues and 6.5 million in EBITDA. And we don't need to add any people. We don't need to add any overhead. The construction is fully financed already by 80% leverage from bank debt. The rest we have as cash reserves. And once we bring in a co-investor, of course, this question, or they will contribute their share of the required equity. So overall, after the transitional 2023, we will see a very, very solid 2024. And once the Guatemala project is online, it will transform our company into a much bigger and much more profitable IPP without us having to add any kind of resources or changing, the structure of our enterprise. And I think this really underlines the great work that we've done and the scalability that is inherent in the model that drives our business. And this concludes my prepared remarks. Thanks to everyone already for listening. And Michael, I'm more than happy to take any questions you might have, and I will also try to
perfect
my camera again. If it's not working, it's not working. But thanks a lot for listening.
Perfect. That's a question. Will all future projects have PPAs? Is that now a part as a set in stone strategic direction for you to always have PPAs on projects you will go into?
I would say 9 out of 10 times it is the norm, because long-term power purchase agreements with credit-worthy off-takers is also key to secure bank financing. In very few markets will a financing bank provide you 70 to 80% of the capital required to build a project if you're fully exposed to the spot market. Being exposed to the spot market as a seller of energy is not an issue when you have high energy prices like right now, but we also know that it's highly volatile, and what we want to create is predictable long-term cash flows. So while we may expose ourselves to the spot markets within the power purchase agreement, I think power purchase agreements will always be signed for our projects, but we may allow for a certain part of the output to be exposed to the volatility of the market risk.
Then there's a question: what do you expect to be the optimal ownership in a project to achieve the highest returns? Because if I listen to you, you said the development phase is probably where you can make the highest value creation. But is there also, if you need to own a project, do you then need to be a majority ownership to ensure that it gets run properly? So a little bit thoughts about that.
Yeah, so during the development phase, we want to control 100% of that activity. We may work with certain partners that help us secure land or cover other parts of the development, but the greenfield phase is really our phase. This is where we want to be 100% owner and active. Yeah. Afterwards, of course, we consider ourselves to be an independent power producer, which means we want to own and operate power plants, and ideally, we hold a majority stake. So for me, I think once we hit the ready to build stage, we either sell it all or we remain in control by retaining 51% or so. 51%. We need to own more. I don't think we should own less. And therefore, this is what we're trying to get, to sell around 50% of the project at ready to build, or sell it outright entirely if we believe we're not the right company to build and operate the plant.
The next question, you opened a little bit yourself. You don't see the stock market giving you the implied value, and looking at your projects and looking at your cash flow versus your market value, it is hard to see that. So there's a question here: could you actually achieve higher returns from share buybacks than on new projects? Meaning that you run down the cash, or you turn those into cash cows, your current projects, and then distribute that. And you have an IRR of I guess 15% on the other projects, but could you actually achieve more on share buybacks or returns, or is that a little bit too short-sighted?
I wouldn't call it short-sighted. I think we need to be open to any kind of ideas out there on what to do with our capital. Of course, our predominant business is developing projects and investing in them and operating them long term. And ultimately, what you would expect is, once the 2024 numbers, which I'm sharing here again, show that we have a strong, profitable portfolio, this should already help demonstrate the true value of the company. Does it mean that the stock price will automatically go up? I don't know. I'm not in control of that. I do believe there's plenty of opportunities out there to continue development and investment in the region at high returns, and I'd rather see capital go into projects at this early stage of our company. Of course, if this is about managing the share price, you could argue that if I believe the company is worth 2 or 3 times what it is in the market right now, and I believe that's the case, I should simply buy it back and make a profit later on. And I'm not shying away from the discussions. We're looking at all kinds of options. We've also seen a lot of transactions out there recently where independent power producers have been acquired by large infrastructure funds, will likely be taken private. I'm not saying that we fall into that category. We're not that big. We're operating in a very special region. But one way or another, either by being patient, which our business requires, by taking measures in the market ourselves, or by exposing us to be taken private way down the road, sooner or later the true value of this company will be materialized one way or another. As a CEO of this company running this, I would like us to build a much better and bigger company to continue on the path that we've taken. But I'm also not closing myself off to any other discussions, especially because this situation that renewable stocks and especially our company has been in for the past year or two has been very frustrating, because you also don't want to take capital measures in the future and undersell your own stock to new investors. So we will look at alternatives, and nothing is strictly off the table.
And one of those is actually, there's a question here. Could you sell down some of the existing projects you have now, and thereby showcasing the value?
Yes, absolutely.
Are you open to that, or is it more farm downs, or could you sell a whole project if the right price came up?
I would say, in terms of selling a whole project, the obvious candidate is the combined heat and power project in our portfolio, neither from a country, nor from a technology or from a size perspective. Can it be considered core, in my view? Because it's strictly speaking also not renewable. It does reduce emissions, it does reduce generation costs, but it's a bit of an odd fit. So in terms of selling a whole project, this is certainly a likely candidate if the valuation that we're seeing for it is right. On all other fronts, I would say bringing in partial investors, also for our brownfield projects in El Salvador and Mexico, is definitely an option. And I think what we need to demonstrate is that we can secure the greenfield returns. And the first project that we can do that with is Guatemala. And that's what we're actively working on. As construction is underway, we are actively looking and speaking to potential core investors. And we're actually very far along in the process. And we hope that we can close and announce a deal fairly soon.
Then actually we are at the right slide. What are the main risks to your 24 expectation? Is it power prices? Is it operational efficiency, or other risks that you, if you should highlight some risks to maybe achieving your outlook expectations?
Yeah, absolutely. So it's, in my view, it's predominantly, and this means high percentage operational risks. The plants have to run, and they have to generate and feed the electricity into the grid. The prices are more or less fixed through the power purchase agreements. The cost structures of these projects is very stable and highly predictable. So unless we see technical failures, which we haven't seen in the past, and we don't expect them for the foreseeable future, these numbers, in my view, are highly achievable. The ultimate thing, as I said before, once the projects are operational, if they're running well, then the only risk that truly remains is whether the off-taker pays the bills or not.
Yeah.
And I think we have that risk for 2024 at least under control.
Perfect. Then there's a question. How much will CapEx be on the Santa Patricio project, your Guatemala project? How big a CapEx is that actually to build this park?
So it's a 65 megawatt peak project. The total construction cost is estimated to be around $42.5 million, including construction contingency, which are normal. And 80% of that will be non-recourse project finance.
Perfect. And then there's a question here. Any progress in talks with possible partners in Guatemala?
Yes, progress, and hopefully something to announce soon, but of course I cannot share any details.
I understand that. And then lastly, also, you talked a little bit about it, and there maybe be some rate expectations. So here in 24, do you see any possibilities that you will actually leverage up, getting also some more debt into your balance sheet? Is it something you are? I think I heard you. It's something you still are targeting to do, but is it possible here in 24?
Well, I think the note that I read this morning is that the US Fed is not in any hurry to cut interest rates. And I think even if we have seen signs of easing up, it's really a project by project assessment. The project that I would like to bring in debt for is our Colombian projects, but the market there is very specific, and 2024, I believe, is a bit unrealistic to put that in motion. And on corporate level, it would really depend on the usage. We could, I mean, let's say raising capital to buy back shares or pay a special dividend, as I said, is not very high on my list of priorities this year. So I think 2024, the interest rate environment will remain challenging, and therefore it would be ambitious to expect us to significantly change the leverage of our company this year. I'm not ruling it out. We keep our eyes open and we're in active discussions, but I think the environment will remain very challenging to pull that off.
I think that was all the questions. Thank you for us. Thank you, Stefan, for taking us through your company and the look into 24. And thank you for the audience for listening in.
Thank you from my side as well. It was absolutely enjoyable. Thanks.